You know that incredibly frustrating feeling? You do all the heavy lifting. You're tracking unemployment numbers, poring over corporate earnings, watching consumer spending. The headlines are screaming that things are getting worse, so you make the smart, logical move with your money, and then the market just completely rips in the exact opposite direction. You lose out or miss out on gains, and your research was literally spot on. You're sitting there staring at the screen thinking, am I the crazy one here? Well, welcome to this explainer. We're going to unpack exactly why this happens, and more importantly, how you can stop getting blindsided by yesterday's news.
Section 1. The Great Market Mystery. Why the data doesn't match the market.
So, why do markets seemingly just ignore the data? It's the ultimate trap for millions of investors every single year. And hey, it's totally valid to feel confused. You look outside, you see a struggling, terrible economy, and then you flip on the financial news to see the stock market having a record-breaking day. It feels completely broken, right? Like the market is this chaotic beast just gaslighting you a little bit. But I promise you, it's not broken. It's actually just playing a totally different game than the one we think it's playing.
Section 2. Economy versus the market. Present reality versus the future auction. To crack this mystery, we've got to completely separate the concept of the economy from the concept of the stock market, because they are absolutely not the same thing. Picture two people standing outside a retail store. The first person is looking right through the front window. They see exactly what's going on inside, maybe empty shelves or a huge line of frustrated customers complaining at the register. They know the exact present reality of that business perfectly. But the second person, they aren't looking in the window at all. They're looking down the street, watching a massive delivery truck pulling up to the building. See, the first person knows exactly what's happening right now, but the second person knows what's about to happen. The financial markets work exactly like that second person. Economic data? That's looking in the store window. The market, on the other hand, is desperately trying to spot that delivery truck.
Let's break that down a bit more, focusing on this massive difference between a scoreboard and an auction. The economy, it moves super slowly. Factories don't just pivot their production lines overnight. Companies don't hire or fire millions of people on a whim, and consumers definitely don't change their deep-rooted spending habits in a single afternoon. Because it's so sluggish, economic statistics basically act like a scoreboard that arrives on a huge delay. It takes weeks, sometimes months, just to collect, process, and revise the data. But the stock market, it's not a real-time scoreboard. It's a lightning-fast auction. You've got millions of participants constantly placing bets on what companies and economies will be worth tomorrow, next month, and next year. And the second those forward-looking expectations change, market prices change immediately. So here is the absolute crucial takeaway. Markets do not simply price what is happening today. They price what investors believe is coming next. By the time that economic data you've been painstakingly researching actually becomes obvious consensus, the market is likely already moved. It just doesn't have the luxury of waiting around for that delayed scoreboard.
Section 3. The power of liquidity. The hidden engine driving the market. If the market is an auction trying to price the future, what's the hidden engine driving all those prices? What are investors trying to anticipate more than anything else? Well, it's liquidity. Now, I know liquidity sounds like complicated financial jargon, but simply put, it's just the availability of money and credit flowing through the financial system and into assets. That's it. It's literally the lifeblood of the whole system. Central banks control this flow with interest rates and their massive balance sheets. Commercial banks tweak it through their lending rules. Governments influence it based on how much they spend and borrow.
When financial conditions ease up and that liquidity increases, all that capital suddenly has a lot more places to go. And here's the kicker. Massive financial institutions don't just leave huge amounts of available capital sitting around in cash. Why? Because cash sitting still gets eaten alive by inflation. They're practically forced to hunt for returns. And that relentless search for yield pushes money further and further out on the risk curve. It floods into stocks, corporate bonds, real estate, commodities, and increasingly crypto. So more money chasing these assets naturally pushes their prices up, even if the present economy, the one you see looking in the store window, is looking pretty weak.
Let's bring this right back to our retail store analogy. Imagine a weak economy. Consumers are nervous, mass layoffs are happening, doom and gloom headlines are everywhere. So why on earth would the market go up? Well, because at that exact same time, maybe interest rates are being slashed, credit is getting easier, investors are expecting a massive wave of liquidity to hit the system over the next year. The market isn't acting irrationally here. It isn't necessarily betting that the economy is healthy today. It's calculating that, thanks to all this incoming liquidity, the economy is about to get a whole lot healthier.
Section 4. The liquidity cycle. How money moves through the system.
This invisible flow of money? It isn't random. It moves through the financial system in a highly predictable, repeating cycle. Let's walk through it together. Step 1. Easy money sparks risk-taking. Borrowing is cheap, so businesses expand and investors buy. Step 2. That risk-taking drives asset prices higher, creating this huge wave of widespread economic confidence. People feel richer, which just fuels even more investment and borrowing. But eventually, we hit Step 3. All that easy money and booming confidence boils over into inflation or financial instability. To keep things from overheating, central banks have to snatch the punch bowl away. They hit the brakes and tighten conditions, which drops us right into Step 4. Liquidity contracts, credit gets super expensive, risk appetite completely vanishes, and asset prices weaken. This painful phase drags on until things get so brutally restrictive that policymakers are forced to start easing again, and boom, the whole cycle resets right back to Step 1.
But here's the real secret to this hidden game. The market usually doesn't wait for the entire cycle to become obvious to the rest of us. It shifts the exact moment expectations about the next phase change. If we are deep in Step 4, that painful contraction phase, do big investors wait for an all-clear signal from the economy? Absolutely not. They won't wait for things to fully recover to start buying. The absolute second they sense policymakers might pivot back to Step 1, the market takes off.
Now, I have to give you a quick warning here. It is way too easy to fall into the trap of oversimplifying this. You can't just say, oh, more liquidity means stocks go up and call it a day. Liquidity is an incredibly powerful force for sure, but it operates inside a super complex system alongside some other massive variables. Where that liquidity goes really matters. Current asset valuations matter. Corporate earnings and fiscal policy matter. And sudden unexpected shocks absolutely matter. For instance, if a major geopolitical conflict unexpectedly breaks out, markets might panic and dump assets no matter how much liquidity central banks are pumping in. Sometimes investors are so terrified of a totally different variable that they completely ignore an improving liquidity. The goal isn't to find one magic trick that predicts everything, it's to understand how the whole system breathes.
Section 5. Anticipate, don't react. The 2 ways to approach markets.
This brings us to probably the most important concept for how you can actually apply all this knowledge. When you really boil it down, there are fundamentally only 2 ways to approach financial markets. First, we have the reactive investor. Most of us are naturally taught to be this person because honestly, it feels safe. This person waits for confirmation. They wait for inflation to officially fall, then they buy. They wait for economic growth to hit the headlines, then they buy. They wait for the scoreboard. But in financial markets, that safety is a total illusion. By the time they finally make a move, the big players have already positioned themselves months ago. On the flip side, we have the anticipatory investor. This person is watching the delivery truck. They're constantly asking, what's changing beneath the surface before everyone else can see it? Are financial conditions loosening up? Are central banks hinting at a shift? They are hunting for changes in expectations long before the actual economic data even budges.
And this leads us right into a really uncomfortable truth about investing. Working harder doesn't automatically mean you win. You could literally spend 12 hours a day reading thousands of reports, memorizing charts, and analyzing known data, and still lose a lot of money. Why? Because the market doesn't reward raw effort. Information is severely diminishing returns the second it becomes obvious consensus. The real edge isn't in knowing what everyone else already knows. It's being right about the future before it becomes obvious.
Ultimately, it all boils down to this incredible concept. The market is a machine for transferring money from people who react to people who anticipate. If you're out there trading solely based on today's headlines, you are reacting. And worse, you are likely just buying the exact assets that the anticipatory investors are more than happy to sell to you at a massive premium.
So, the next time you look at the market and feel that familiar frustration about why it's moving completely opposite to the economic data, I want you to stop and ask yourself this final question. What is the market expecting that the economy hasn't shown yet? What delivery truck is the market watching right now that hasn't even arrived at the store? Look beneath the surface, track the flow of liquidity, and start anticipating the future rather than reacting to the past. Think about that for a second. Thanks so much for joining me on this explainer. Keep questioning, keep looking ahead, and I'll catch you next time.